Hello everyone and welcome to Fun with Fitzy. We are on 7th video of chapter 9 and this is going to be our ratios video. As you recall from at the end of each chapter we talk about ratios. So we're going to look at ratios involving accounts receivable and we're going to also look at the balance sheet presentation of receivables. So each of the major types of receivables should be identified in the balance sheet or in the notes to the financial statements. Each of the major types of receivables should be identified in the balance sheet or in the notes to the financial statements. So in the balance sheet, short-term receivables are reported within the current asset section below cash and temporary investments. So those would be your accounts receivables, your interest receivables, your short notes receivables, and things like that. Both the gross amount of the receivables and the allowance for doubtful accounts should be reported, which ultimately leaves your net realizable value. Remember that? Because the amount of your receivables minus the allowance for doubtful accounts equals this. And we've seen this before already. Okay, let's look at ratios. So we have 4 ratios that we're going to look at. And we've already looked at the current ratio, I believe, but I think we're going to review it right now. All of these evaluate the short-term liquidity of a company. And when we talked about liquidity earlier, just to remind you, it measures how quickly a company can pay off its debts. And you also recognize the term liquidity as meaning how quickly you can convert your assets to cash. Okay, so we're going to look at the current ratio, the acid test ratio, the receivables turnover ratio, and the collection period. And these two are related to each other, just like the inventory turnover and the day sales in inventory. So let's look at the current ratio first. The current ratio is also called the working capital, and I do remember doing this. It's current assets divided by current liabilities. I remember telling you guys that so that was review. The acid test ratio is also known as the quick ratio. You're going to need to know these ratios for your summative project. Is a measure of a company's short-term liquidity as well. Now the difference is here, it's very similar to the ratio we just looked at. However, we're only taking cash, temporary investments. These are like GICs and stuff like that. Some companies have them right between cash and accounts receivables. And we're going to leave things like merchandise inventory out of it. So it just really tightens up that current ratio that we just looked at. Because these things, receivables and temporary investments and cash, can be converted to cash much faster than things like inventory. So those current assets that can be converted to cash quickly, divided by current liabilities, will give you the quick ratio. And like I said, this tightens up the current ratio. Now the accounts receivable turnover ratio, this talks to us about how quickly we can make our collections. And this one's not in the basis of time. So we're going to take our credit sales, and again, we're not going to take our sales because some sales are made by cash. So we only want credit sales. And remember, when we say net, that means less any returns we've had. So we're going to take our net credit sales, divide it by our average net receivables. Remember when we talked about this when we were doing our inventory and merchandise inventory, average receivables would be your beginning accounts receivable plus your ending accounts receivable divided by 2. Remember, when you compare a balance sheet item to an income statement item, you have to take the average of the balance sheet item so that it compares the same time period. For example, if this income statement is for 1 year, this net credit sales is for 1 year, then you need to get 1 year of average receivables. So your beginning plus your ending divided by 2 will give you an average. And that's going to give you your receivables turnover. So this is going to give you like how many times you collect your receivable in a year. Now that's hard to determine because this is going to give you a number like 12 or 14, and it's not easily understood if that's good or bad. So what we do is we look at the next ratio called the collection period. And the collection period converts that ratio into days. So it's going to convert accounts receivable turnover ratio into days. So for example, basically, again, this is like the inventory turnover one. You're going to take 365 and you're going to, let's say your answer was 12 for the inventory turnover. That's going to give you 30.4. And that's days. So what they're saying here is, on average, the number of days it takes to collect your accounts receivable is 30 days based on these numbers. Is that good or bad? Well, if you think about it, the terms usually are 30 days for a company to collect their accounts receivable. Remember the terms like 2%, 10, net 30? So if you're collecting your accounts receivable on average in 30 days, you're collecting them on time. So anything less than 30 days, let's say your company is collecting in 20 days, your accounts receivable department's doing a great job. If it's taking you 45 days, if this ratio is coming up at 45 days, your accounts receivable department is very slow. There might be some issues why. Some customers are paying slower than they should. So that's kind of how you determine that one. The general rule is the collection period should not exceed the credit terms. So that's what we were just talking about. If the terms, in this case, were net 45, let's say, and your collection period was 30 days, you're doing really well. However, if your terms are 30 days and you have 30, you're not doing as well. Okay, so it depends on what the credit term is. I also wanted you to recognize that this is also called DSO, and it stands for Days Sales Outstanding. How long is it taking your customers to pay for their sales or their purchases from you, your sales? Okay, so by now you should be able to explain and calculate those 4 ratios: the current ratio, the acid test ratio, accounts receivable turnover and collection period, and you should also understand the balance sheet presentation of receivables. Hope that helped. Talk to you soon.